Most traders don't struggle because they lack a strategy. They struggle because the levels they use may not reflect what the market is actually reacting to. Many end up buying near potential resistance, selling near potential support, or relying on trend lines that the market doesn't respect. If you've ever felt out of sync with price, this lesson may help you understand why and what you can adjust to read the market more clearly. Before we go any deeper, it's important to clarify something. This content is for educational purposes only and reflects personal opinions, not financial advice. Now that this is clear, let's take a look at what we'll explore in this lesson: the hidden logic behind support and resistance, how to draw levels with precision and confidence, a complete support and resistance trading strategy, how trend lines reveal the market's rhythm, how to draw accurate high-quality trend lines, a trendline trading strategy, real chart examples, and how these concepts can be applied across different markets and timeframes. If you find this helpful, please like the video, subscribe to the channel, and turn on the notification bell for more trading lessons like this. With that said, let's dive straight into the first concept. Support and resistance are the backbone of technical analysis. If you learn to identify them properly, you automatically trade with more confidence, more clarity, and more accuracy. These levels show you exactly where price is likely to react, and they help you avoid bad trades while focusing only on high probability zones. Before price reaches these areas again, you must already have them marked in advance, because this is where your best trade opportunities will come from. Here are the 6 criteria every strong support or resistance level must meet. Major swing highs and swing lows. Start with the most important turning points on the chart. Every strong support or resistance level begins with a clear rejection point, the highest high or the lowest low of a recent move. These extreme points show you where buyers or sellers stepped in aggressively, and price often returns to react there again. Multiple price rejections. A level becomes stronger each time it's respected. If price has touched the same zone several times without breaking it, that tells you institutions are defending that level. Think of it like a wall. The more times price hits it and fails to break, the more significant it becomes. The level must be obvious. If you need to force it or squint your eyes to see it, it's not a real level. The best support and resistance zones are the ones that pop out instantly when you open a chart. Simple, clean, and clear. Strong and aggressive reactions. If price bounces away explosively from a level, large candles, fast movement, that's a sign of serious buying or selling pressure entering the market. The stronger the reaction, the more important the level. This is where institutions leave their footprint. Role reversal. When support becomes resistance and resistance becomes support. This is one of the most powerful confirmations. If a resistance level is broken and later holds as support, it tells you the level is valid, respected, and high quality. And the same applies in reverse. This is a classic smart money signature. Recent respect of the level. Fresh levels matter more than old ones. A level that was tested recently carries more weight than something from several months ago. The market cares about what's happening now, not what happened far in the past. Always give priority to recent price action. Before we move forward, here's something important to remember. A support or resistance level doesn't need to meet all 6 criteria to be valid, but the more criteria it satisfies, the stronger and more reliable the level becomes. Now let's jump into the charts and break everything down step by step so you can see how each trait actually appears in real market conditions. Identifying extreme swing highs and swing lows. The first thing we want to spot on any chart is the highest point and the lowest point that price has reached during the most recent move. On the chart, you'll notice price pushes up, hits a peak, and reverses. That's your swing high, a potential resistance level. Price drops, forms a bottom, and bounces back up. That's your swing low, a potential support level. But here's the key. We never take trades just because price taps a high or a low. These levels are only reference points. We wait for price action confirmation before making any decisions. Multiple price rejections strengthen the level. A single touch means nothing. What matters is how many times price reacts to the same area. In the chart example, price tested the same level 3 times and rejected it every time. This tells us traders are actively responding to that zone. Institutions may be defending it. The probability of future reactions increases. When price repeatedly refuses to break a level, it becomes a high-quality support or resistance zone. The level must be obvious. Strong levels stand out instantly. If you need to force it or overanalyze the chart to find a level, it's not strong enough. On the chart, the resistance level is obvious because price reversed cleanly from it multiple times. The support level below is also clear because price bounced strongly off it. Yes, there are smaller intraday levels too, but for now, focus on the ones that are clear, visible, and respected by the majority of traders. Why? Because the more traders who see a level, the more likely price is to react there again. Look at the strength of the reaction. The quality of a level is measured by how aggressively price moves away from it. When price touches a zone and immediately rejects with large, strong candles, that's a sign of heavy buying pressure, strong selling pressure. In the chart, every touch is followed by a sharp move away, that's institutional activity, and it tells you the level is important. Role reversal. Support becomes resistance and resistance becomes support. One of the most powerful confirmations is when a level flips roles. On the chart example, price rejected a resistance level twice, then finally broke above it. When price came back down, the same level held as support. This flip, known as role reversal, is a signature of high-quality levels used by smart money. When you see this, keep the level marked. It will likely matter again. The level was recently respected or formed. Fresh levels always carry more weight. Even though historical swing highs and lows can still be relevant, the most meaningful levels are the ones that have been respected recently. Have clear and recent reactions, which means the level is still relevant in the current market. In the chart example, the resistance zone was tested multiple times in the recent past, making it highly relevant for upcoming trades. Now that you know exactly what to look for, we'll start marking the key support and resistance zones directly on the chart. But before we dive into that, remember, not every level needs to meet all the criteria, but the more criteria a level checks off, the stronger and more reliable it becomes. Now that you understand the criteria, let's apply everything step by step on the chart. We start from the highest point on the chart, the area where price pushed up, reached a peak, and reversed sharply. That point becomes our first resistance level. Let's plot it. So why is this a strong resistance level? Here's why this one deserves to be on your chart. Extreme swing high. This is the highest price reached during the recent move, which automatically makes it a key resistance zone. Clearly visible, it stands out instantly. Any trader glancing at the chart would identify this level immediately. That's what makes a level truly meaningful. Strong rejection. After touching this area, price didn't hesitate. It dropped aggressively. A move like that shows real selling pressure. Multiple rejections. Price tested this resistance twice and failed to break through. Two clean rejections create what traders call a double top, a strong bearish sign. This is exactly the type of level you want to mark. Next, as we move down the chart, we find another important zone, one that reacted multiple times and played both roles, support and resistance. Let's draw it in and break it down. Multiple rejections. Price hit this level 5 different times, confirming how significant this zone is. The more tests, the stronger the level. Role reversal. This is one of the strongest signs of an important level. At first, price bounced up from this area acting as support. Later, after breaking below, price rejected it from below acting as resistance. A true smart money level. Recently respected. This level is active in the current market. Recent reactions always matter more than older ones. Strong price movements. Every touch was followed by an explosive move away. This confirms institutional activity around that zone. Easy to identify. It's clean, simple, and obvious. The type of level most traders react to. This makes it a high probability area for future trades. Now we go further down and find the next key support zone. A level where price bounced twice with strong reactions. Let's mark it and analyze it. Extreme swing low. This is the lowest point reached during the recent movement, which automatically makes it a strong support level. Multiple rejections. Price tested this area twice and bounced both times. That's proof that buyers are active around this level. Strong reactions. Each time price touched this zone, it reversed sharply. Strong rebounds mean strong demand. Clearly visible, just like the earlier levels, this support zone stands out immediately. No overthinking, no guessing. Recently respected. Price touched this level recently, which means it is still relevant for current and upcoming trades. One of the most common questions traders ask is, should I draw my support and resistance as single lines or should I use zones? Let's break this down using a clean example from the British pound, Japanese yen. Sometimes, price reacts so cleanly that all reversal points align perfectly along one straight level. In this chart example, by plotting a single horizontal line, we immediately see a clear and obvious resistance level. The turning points match the line almost perfectly. Candle closes, wicks, everything. In situations like this, drawing one line is simple, clean, and accurate. But most of the time, the market does not react to one precise price. Instead, it reacts to a zone, an area where both buyers and sellers are active. Take a look at this example. At this level, price doesn't touch one exact price point. Sometimes it reacts to the wick, other times to the candle close, and occasionally it barely taps the area before reversing. So what do many beginners do? They start drawing multiple lines, one for the wicks, one for the closes, one for the intraday spike, and one for the rejection candle. Let's add them. And now the chart looks messy, confusing, and impossible to follow. Instead of forcing every close and wick into a separate line, the better approach is to mark a zone that includes the candle bodies, the wicks, the entire area where price reacted multiple times. This is much cleaner, much clearer, and far closer to how price actually behaves. Price doesn't respect a magic number, it respects areas where orders accumulate. A zone gives you a realistic, professional view of the market, not a cluttered diagram full of unnecessary lines. Now let's use support and resistance to trade the market with a simple trading strategy. As you can see on this US dollar Japanese yen 1-minute chart, the market is trending upward. We have the first impulsive move, followed by a retracement, and then another impulsive leg. Here we mark our first support level because it is the extreme swing low. It's obvious, it's clean, and it's recent. As you can see, we don't need all 6 criteria. 2 strong criteria are more than enough. This is our next support level, and here we have a resistance level that later turned into support after the breakout. By drawing these key levels, we immediately know the hot spots where the market is likely to bounce. After the impulsive move, we expect a retracement as buyers take profit, so price pulls back, and the closest hotspot is this resistance turned support level. Now, look at what happens next. Price pulls back, forming a clean retracement, and once it reaches the support level, it gets rejected and forms this bullish doji candlestick. The long wick shows sellers were rejected and buyers stepped back in, signaling the beginning of a new impulsive move. Now let's jump to the 15-minute time frame, which is the higher time frame for the 1 minute, to see if it supports our setup. On the 15-minute chart, we have an obvious support level, so let's draw it. Once we mark the level, we get a very important piece of information. Price came back to this support and created a clear liquidity sweep. This sweep tells us the market is likely to push at least toward this previous support that now acts as resistance. So now, the higher time frame fully supports the trade setup we spotted on the 1-minute chart. Let's go back to the 1 minute to take the trade. We enter at the close of the bullish doji, place our stop loss below the support level, and aim for at least a 2-to-1 reward to risk ratio. This trade offers us a clean 3-to-1 reward to risk. Now let's move to another trade example. This is the Australian dollar Japanese yen 5-minute chart. As you can see, the market is trending upward. Price hits this level and reverses, hits it again and reverses, and hits it a third time and reverses. This creates a clear and obvious resistance level. As we said earlier, multiple rejections show the strength of a level. Here we had a minor support level that was broken and briefly turned into resistance, but the breakout that followed invalidates that level, so we can remove it. Below, we have an obvious support level, and another clean support level slightly lower. So by simply drawing these support and resistance levels, we can now read the market clearly and anticipate what is likely to happen next. Here, the market performs a clear liquidity sweep, then moves up aggressively. Price is likely to continue higher, but it must first face this resistance level again. And look at what happens. Price reaches the resistance level, taps it, and reverses, forming a bearish engulfing candle. This candlestick pattern shows that buyers were overpowered by sellers, signaling that the market is likely to move down again, at least toward the next support level. But before taking the trade, we must check the higher time frame. Since this is a 5-minute chart, let's switch to the 30-minute chart to see whether the higher time frame supports our setup. On the 30-minute chart, we draw our key levels. Here's a support level, another support level that turned into resistance, and another resistance level above. We can see that price hit this support, turned resistance level, and moved down. It tapped it again, and a red candle formed, confirming bearish momentum and suggesting the market is likely to continue downward, which aligns perfectly with our setup on the 5-minute chart. Now let's return to the 5-minute time frame and take the trade. We enter at the close of the bearish engulfing candle, place our stop loss above the level, and target the next support zone. This trade offers a clean 2-to-1 reward to risk ratio. And look at what happened next. As you can see, the price moves straight to our target exactly as expected. Now that you can identify and draw strong support and resistance levels and use them to trade with confidence, the next smart money tool you need is Trendlines. Trendlines help you see the rhythm of the market, how price moves in waves, where pullbacks are likely to end, and where new runs are likely to begin. They allow you to read the trend with clarity and anticipate future reactions before they happen. Let's break it down. A trendline is one of the simplest yet most powerful tools in technical analysis. It's a line you draw on your chart to connect swing highs or swing lows in a trending market. Trendlines help you identify the direction of the trend, locate high probability pullbacks, and confirm entries. In a downtrend, price moves in clear waves: run, pullback, another run. Here's how we define the structure. The lowest point before a pullback begins is called the swing low. The highest point before the next drop starts is called the swing high. In a strong downtrend, price forms lower highs and lower lows. And it's these lower highs we connect. To draw a trend line in a downtrend, connect the swing highs along the top of the move. This creates a clean downward sloping line that acts as dynamic resistance. This is where sellers are likely to step in again. To draw a trend line in an uptrend, the structure is the same but flipped. Run followed by a pullback, another run followed by a pullback. Here, the highest point before a pullback begins is called the swing high. The lowest point before the next upward run is called the swing low. In a strong uptrend, you'll see higher highs and higher lows, and it's the rising swing lows we connect. To draw a trend line in an uptrend, connect the swing lows along the bottom of the movement. This creates a rising trend line that acts as dynamic support. This is where buyers are likely to enter again. Now, keep in mind, real market conditions are rarely this clean. Price doesn't move in a perfect straight line, but understanding this basic structure helps you read the market flow with far more confidence. So let's answer the big question: why do we even draw trend lines? There are two core reasons traders use trend lines. In an uptrend, the trend line acts as dynamic support. When price pulls back toward it, it often bounces and continues higher. In a downtrend, the trend line acts as dynamic resistance. Each time price retraces toward the trend line, it often rejects downward. But here's an important rule: never enter a trade just because price touches a trend line. Always wait for confirmation. And later in this video, I'll show you exactly how to confirm trendline trades properly. Trend lines don't just guide the current trend, they also help identify when momentum is shifting. In a downtrend, the trend line sits above price. If price breaks above this trend line, it may be the first clue of a possible transition into an uptrend. In an uptrend, the trend line sits below price. If price breaks below it, that could signal the beginning of a shift into a downtrend. But remember, a trendline break does not automatically mean the trend has reversed. You still need additional confirmations, and we'll go over them in the next section. Now that you understand what trend lines represent and why they matter, let's break down the key principles to draw them correctly. These rules will help you stay consistent and avoid rookie mistakes. You need at least 2 touches. A valid trend line requires a minimum of 2 touches. More touches strengthen the trend line, but more touches do not guarantee the trend line will hold next time. It simply means traders have reacted to that line before. Trends are rarely perfect. Markets are choppy, irregular, and unpredictable. Price won't always respect your trend line perfectly. In this example, price broke below the trend line, then closed right back above it. A messy reaction that shows the trend line wasn't respected cleanly. This is normal in real market conditions. Treat trend lines as zones, not exact lines. A trend line is a guide, not a laser-precise barrier. Price won't always touch the trend line perfectly. Sometimes, price reverses before touching the trend line. Price overshoots and comes back. Price hesitates around the zone. In this example, price bounced from the general area of the trend line without touching it exactly. And the same thing happened here. This shows that trend lines represent areas, not exact prices. But as a trader, you should still draw them and remain disciplined. And here, we finally get the perfect reaction. Price retraced, retested the trend line, got rejected, and continued upward. A clean, textbook trend line bounce. Don't force trend lines. This is a big mistake traders make. If the trend line is obvious and fits naturally with the swing structure, draw it. If it doesn't, leave it out. Here's an example. The initial trend line we drew was incorrect because we ignored a major touch point just to make the line look good. That's forcing a trend line, and it's a mistake. The correct approach is simple. Identify the real swing highs or swing lows. Draw the trend line honestly. Then wait and see how price reacts. Never force a line just to make the chart look cleaner. Follow the market. Don't try to control it. One of the most common questions traders ask is, do I draw my trend line using the wicks, the candle bodies, or both? Here's the simple professional answer. Draw your trend line wherever it gives you the most touches. Trend lines are about connection and consistency, not perfection. Let's break it down. Here's a clean downtrend. If we draw the trend line by aligning it with the maximum number of swing points, something interesting happens. At some points, the trend line touches the wicks perfectly. At other points, it cuts slightly through a wick to touch a candle body. And in some places, it connects both. This is normal, and it's exactly what we want. The goal is to hit as many relevant points as possible, not stick to a single rule. The more touches you get, the more meaningful the trend line becomes. Now let's look at the lower trend line. Just like before, some touches line up with wick lows, some line up with candle bodies, some require a mix to maintain consistency, and that's completely fine. You're aiming for the highest number of valid connections, not the most precise artistic drawing. Alright, let's bring all these concepts together and apply them to a real chart example. This is the Euro-US dollar on the 5-minute chart. As you can see, the market begins to trend downward, which indicates that sellers may currently have control. In this kind of environment, some traders look for potential selling opportunities. Now let's connect the swing highs to check whether we have a valid trend line. By joining these swing highs, we get a clean downward sloping trend line. Once the trend line is established, the next step is to wait for price to retrace back into that area to see how it reacts. Here, when the market pulled back to the trend line, it rejected strongly and formed a clear bearish pin bar pattern. A pattern like this simply shows that sellers may be stepping back into the market and defending the trend line area. Before considering any entry, it's important to check the higher time frame to see whether it supports the idea. On the 30-minute chart, we can clearly see that the broader market structure is still bearish, which aligns with the pullback setup we saw on the 5-minute chart. With both timeframes pointing in the same direction, the setup becomes more structured. Now let's return to the 5-minute timeframe. Some traders place their entry after the confirmation candle closes, with the stop loss positioned above the trendline zone or the most recent minor resistance to manage risk in case the market fluctuates. The potential target is often set at a level that provides at least a possible 2-to-1 risk-to-reward ratio, depending on market conditions. Here's what happened next. Price continued moving downward and eventually reached the projected target area. This example shows how a trendline pullback, combined with a candlestick rejection and higher time frame alignment, may help traders understand market structure more clearly. Now, let's look at another chart example. This is the Australian dollar Japanese yen on the 5-minute time frame. As you can see, the market is trending downward. So we start by connecting the swing highs to draw a trend line. Here, we were able to connect 3 clean points, giving us a valid and well-respected trend line. The market reacted to this trend line 3 times, so when price retraced back into it again, many traders would look for signs that the downtrend may continue. Now look at what happened next. Once the market retraced back to the trend line, we got a clear pin bar rejection. Then, shortly after, a second pin bar formed in the same area. If someone missed the first signal, the second one provided another potential confirmation that sellers might be defending the trendline zone. Let's move to the higher time frame. On the 30-minute chart, the market had been trending upward earlier, but it reached a first top, then a second top, forming a potential double top pattern. A structure like this may signal a loss of bullish momentum and a possible shift toward a downtrend, depending on market conditions. This higher time frame behavior supports the idea we saw on the 5-minute chart. Now let's return to the 5-minute time frame to complete the setup. Some traders would place their entry after the pin bar closes, set the stop loss above the trend line or minor resistance to manage risk, and then aim for a target that offers a potential 2-to-1 risk-to-reward ratio. Look at what happened next. Price continued downward and eventually reached the projected target area, completing the structure of the setup. You can apply the same technique in an uptrend, and this approach can also be used on higher time frames such as the 1 hour, 4 hour, or even the daily chart. It's a flexible concept that many traders use to understand trend continuation and market structure. This content is for educational purposes only and reflects personal opinions, not financial advice. Trading involves risk, and you should consult a licensed financial professional before making investment decisions. If you found this lesson helpful, feel free to like the video, subscribe to the channel, and hit the notification bell so you don't miss future educational content. Thank you for watching, and I'll see you in the next video.